video, we are going to talk about formulas of finance for revision before phase 2 examination. So, a lot of students had been asking me as to how can we revise finance, especially the practical part, and because there are so many formulas, so it becomes very difficult. So, I thought let's make a video which covers all the formulas in a very short span of time so that you know what have you covered, what have you not covered, and cover the areas which are left out and revise the areas which you have already covered. So there are a total of 8 topics that we're going to cover in this revision video. In this particular video, we are going to cover 5 of them, and in the next video, we are going to cover the remaining 3 topics. So the 5 topics that we're going to cover are cost of capital, leverages, capital structure, capital budgeting, and time value of money. Let's start with cost of capital first. So I'm not going to explain what is cost of capital, what are the fundamentals, because I expect you to already know those things. We're going to discuss only the formulas related to cost of capital. First is cost of debt. We have to find out, if we have to find out in a question cost of debt which is irredeemable in nature, then the formula is KD, which is cost of debt, is equal to I is the interest rate which the firm has to give out if it is issuing a particular debt to the investor. 1 minus T is the tax rate, so you remove tax advantage from the cost of debt, because an institution or an organization receives certain tax advantage when it issues debt to an investor, and you divide it by net proceeds, or the money that the issuer gets when the investor invests in the company in the form of debt. So this is for irredeemable cost of debt. Now let's come to the redeemable part of cost of debt. So there's an approx formula which gives you the approximate value of cost of debt. It is a shortcut. It is used to find out the value which is near the exact value, so that you can get to the value as fast as possible using the trial and error method. So the formula is I1 minus T, again similar to irredeemable formula, plus RP. So RP is redemption proceeds, NP is net proceeds, divided by N is number of years, and then you divide the entire thing by RP plus NP, that is redemption proceeds plus net proceeds divided by 2. So you get the approximate value of cost of debt in case of a redeemable debt in the company. Next is cost of preference shares. So we have already discussed cost of debt. Now let's come to cost of preference shares. In case of irredeemable, the cost of preference share, which is KP, is D, which is the dividend, divided by net proceeds, which is the money received by the firm on issuing a certain number of preference shares to the investor. Next is impact of corporate dividend tax. This is very important because this was not asked last year in the examination, but this is a higher level of finding out cost of capital, and therefore it can be asked in this year. So KP, or cost of preference share, becomes D bracket 1 plus corporate dividend tax rate. So in place of rather than reducing the tax rate, you add the corporate dividend tax rate in case of preference shares, wherein the impact of corporate dividend tax is to be taken care of, divided by net proceeds. When you're talking about redeemable, the approximate formula is KP is equal to D dividend plus RP. It is similar or the same as that in cost of capital for debt, which is redemption proceeds minus net proceeds divided by N number of years, the entire thing divided by net proceeds plus redemption proceeds divided by 2. The impact of corporate dividend tax rate in case of redeemable preference shares is KPD1 plus CDT. So you just add 1 plus CDT, or corporate dividend tax rate, and the entire formula remains the same. Next is cost of capital for equity. So if you're issuing equity, then what is the cost of capital? Now one formula is for constant growth model, wherein the dividend is growing constantly in the organization. So if you're paying 10% today, the next year it is 20%, let's say, the next year it is 30%. So it is growing constantly. The dividend is growing constantly. In that case, cost of equity is D1. Now there is a difference between D0 and D1. D0 is the dividend which is given at the start of a year. So if you're talking about the year 2016-17, then on 1st April 2016, if there is a dividend given, then that dividend is called as D0. Whereas D1 would be the dividend to be given on 31st March 2017, which is end of the year. So we take into consideration only D1 and not D0. So if there is D0 given and you're given G, then D1 becomes D0 1 plus G. So this is D1. So here D1 upon P0, P0 is equal to net proceeds or the current market value at which it is purchased by the investor, plus G is the constant growth rate which is given in the question. Impact of corporate dividend tax rate, again KE or cost of equity becomes D1 1 plus CDT rate, 1 plus corporate dividend tax rate upon P0 and then plus growth rate. Now we're talking about CAPM or capital asset pricing model, wherein beta can be asked or cost of equity can be asked using CAPM. So the formula is RF, which is the return on risk-free rate of return plus beta, the entire thing multiplied by RM, which is the market rate of return minus risk-free rate of return. So risk-free rate of return is the rate of return which is earned on government securities, because there is assumed that there is no risk on certain securities like the government securities. So that is the risk-free rate of return. And market rate of return is the rate of return which is given, which is the average return receivable in the market on similar securities. So RM minus RF becomes the additional return which the investor would get in order for investing in a riskful in a security which has certain amount of risk, uh, multiplied by beta plus RF. So this is the formula for CAPM to find out cost of equity. Next is cost of weighted average cost of capital. Now, if you're given a portfolio wherein you have KE, where you have, for example, equity, where you have certain debt, and where you have certain preference shares. So, how do you find out the cost of capital of all these three combined? Now, there is a method for that. So, cost of weighted average cost of capital for all these three will be called as KO, and it is KD into WD, wherein KD is the cost of debt. What is the cost of debt? And you multiply it by the share of cost of the entire debt in the entire capital structure of the company. So for example, if a company issues 60% equity, 20% debt, and 20% preference shares, then the cost of debt, the WD becomes zero point 0.2 or 20%. Similarly, WP or preference will again be 0.2 or 20%, and weight of equity will be 60% or 0.6. So this is how you find out weighted average cost of capital. This also has not been asked in the examination till date, but this is a variation of the kind of questions that have been asked, and there are chances that these kind of small 2 markers can be asked in the examination as well. Let's come to leverages, the second topic now. So the first one is degree of operating leverage. So there are two formulas for degree of operating leverage. The first one is contribution upon EBIT, and the second one is percentage change in EBIT upon percentage change in sales. Now this second formula is used when either there are 2 years of data given, data of 2 years given, or there is two companies, data of two companies given when you're comparing different companies or different projects. So this is useful only when you're making comparison, and the first formula is used when a single data is given, data set is given. So degree of operating leverage is contribution upon EBIT or percentage change in EBIT upon percentage change in sales. Degree of financial leverage is EBIT upon EBT. EBIT is earning before interest and taxes upon earning before taxes, but you reduce preference dividend and you divide preference dividend by 1 minus T. So you are removing the tax disadvantage that pertains to preference dividend, and therefore 1 minus T is divided by preference dividend. The next one, the second formula is when you're again comparing two sets of data, percentage change in EPS upon percentage change in EBIT. Similarly, degree of combined leverage is contribution upon earning before taxes minus again preference dividend upon 1 minus T, or percentage change in EPS upon percentage change in sales. So I'm not explaining all these formulas because we've already done that when we talked about the entire finance as a course. So I'm only providing you all the important formulas here. The next one is break-even point in leverages, which is very important. Last year one question was asked from break-even point as well. So the first one is break-even point operating for units. So the formula is operating fixed cost. Operating fixed cost is similar to the fixed cost which is given um, in a particular question upon contribution per unit. It's important to remember contribution per unit. And we're talking about, when we're talking about operating break-even point in terms of rupees, then again it is fixed cost remains the same, but you divide it by PV ratio. And PV ratio can be defined as contribution upon sales into 100. Contribution upon sales into 100 is the PV ratio. So this is how you find out operating break-even point for in terms of rupees and in terms of units. Next is financial break-even point. Financial break-even point in terms of rupees is interest on debt. Interest on debt, it is again a fixed cost plus preference dividend divided by 1 minus t. So you're removing the tax disadvantage. So preference dividend is again a fixed kind of a cost, because every organization making a profit has to give certain amount of preference dividend as a mandatory requirement, and therefore financial break-even point is interest on debt plus preference dividend divided by 1 minus t in terms of units. Next is leverages for operating break-even point in terms of units. So in terms of units, if you want to find out overall break-even point, then it's fixed cost for operating plus fixed cost for finance divided by contribution per unit. And overall break-even point in terms of rupees, if you want to find out, you divide it by PV ratio rather than dividing it by contribution per unit, just like you did it in the case of operating break-even point in terms of rupees. Next is capital structure. The first important area that we're going to cover is indifference point. How do you find out indifference point in capital structure of a company? So indifference point is a point wherein there is no profit and no loss. So how is it found out? EBIT, earning before interest and taxes, minus interest that is to be given. Then you multiply it by 1 minus t and you reduce preference dividend upon number of equity share in alternative 1. So alternative 1, there are always two alternatives when you're finding out indifference point. So number of equity shares in alternative 1, number of equity shares in alternative 2 on the right hand side, and then you on the numerator you have EBIT minus I, similar 1 minus t minus preference dividend. So in both these alternatives, what you're doing is you are comparing EBIT, interest and preference dividend in alternative 1 with alternative 2 in order to find out the indifference point. Next is comparing value of levered and unlevered firm. This has not been covered in the course, but I think it is important to remember the formula at least, because it was not asked in the examination last year and last to last year, but there can be a small question in this area as well. So value of levered firm. Levered firm is a firm which has given out certain cost of debt, certain debt. So therefore it has some amount of leverage. And unlevered firm is which has the capital structure of a firm made up of only equity, is called as unlevered firm. So value of levered firm is value of unlevered firm plus debt, D is the debt, into total corporate tax rate that is there in the company. So corporate tax rate into debt, amount of debt, plus value of unlevered firm gives us value of levered firm. The next is capital budgeting. The first one and the simplest one is payback period. Payback period can be found out using this formula. Initial investment that the firm makes upon net annual cash inflows that the firm receives from making a particular investment gives us the payback period. Next is net present value. Net present value can be found out using the formula of present value of cash inflows minus present value of cash outflows. Now these are the inflows and this is the outflow. So this is what we are doing here. So cash inflow in the first year, at the starting of first year, cash inflow at the end of 1 year, cash inflow, and it goes on till n year. So cash flow till the end of nth year, and then you reduce cash outflow from this entire value that you receive in terms of cash inflow. Now the next one is IRR, which is the internal rate of return, and IRR can be defined as the discount rate which makes NPV as 0. So IRR is this K, the value of K would be IRR, wherein cash inflows will be equal to cash outflows. So let's find out. The formula says cash outflow upon is equal to all these inflows. All these on the right hand side are inflows. Cash inflow in the starting of 1 year upon 1 plus k raised to power 0. Again cash flow at the end of 1 year, and this goes on till nth year, and then you receive certain salvage inflow as well. If you have invested in a machinery, you sell that machinery at the end of nth year, and then you receive certain salvage value. So this is also included in the inflows, and then you keep it equal to cash outflow in order to find out this value of this K, which is the internal rate of return. So there's an approximate formula for IRR as well, which helps you to use trial and error better in order to find out IRR, actual IRR at the earliest way, in the earliest time period. And the approximate formula is L plus A into H minus L upon A minus B. Let's understand this. L is the lower rate of return where NPV is positive. So you find out a particular NPV, for example, 12%, 13% you're making all these trial and errors, and at 12% NPV is positive, so this is L. L is the lower rate of return wherein NPV is positive. H is the higher rate of return where NPV is negative. So let's say H comes out to be 13%, that is the rate of return where NPV becomes negative. And NPV at lower rate of return, or L, so what is the value of NPV at 12%? That is A, and B is the value of NPV at 13% would be B. So using these four terms, you are able to find out IRR approximate value, and then you can move on to trial and error method of IRR, which I've already explained in the course. Next is finding PVAF, or annuity. In case of annuity, the formula that can be used, shortcut formula, is this: 1 minus 1 upon, so let me write it in a better manner, 1 minus 1 upon 1 plus I, or the interest rate raised to power n, or the number of years, and then you divide this entire thing by I, not 1, by I, which is the interest rate. So this gives you PVAF, or present value of annuity factor. Now there's another formula which is equity annuity method. So this is used when the time periods of two different projects is not the same. So what do? First of all, you find out NPV of both the projects, but they cannot be compared because the time periods of these two projects are different. And then you divide the entire thing by PVAF. So PVAF can be found out using this formula that I mentioned here. The next is time value of money. Time value of money, you find out present value and future value. So present value is future value divided by 1 plus R. R is the rate of return raised to power n, and in future value you take 1 plus R raised to power n to the left hand side, so it becomes present value into 1 plus R raised to power n. So when there is intra-year compounding, which means that the rate of return is half year, quarterly, or monthly, then what do? You find out future value as present value into 1 plus R upon M. So R is reduced. So if there is 12% R yearly, then half yearly it becomes 12 by 2, which is 6%. Or if it is quarterly, then it becomes 12 by 4, or 3%. So this is how you reduce the value of R, but you multiply the value of N by M. So if there is quarterly, then N becomes 2 rather than 1, which would be yearly. N becomes 2 because you multiply it by 2, wherein you divide it 2 in case of R. So you divide 2 by R from R, but you multiply 2 in N, or number of years, in order to find out the future value. Future value of annuity, so we found out the present value of annuity factor using that formula. There is another formula which gives us future value of annuity. The formula is A into 1 plus R raised to power n minus 1 upon R. So R is the rate of return as the number of years, and A is the annuity that you are going to receive. So this is how you find out future value of annuity. So we have covered 5 topics in this video. In the next video, we are going to cover the 3 remaining topics and revise all the important formulas in those topics.